the last panel discussion, how important some of the regulatory issues are here. It's largely because finance is such a heavily regulated industry. So very excited to have this group of folks here. So Anna Mills is a partner at Womble, Bond & Dickinson's, worked on global M&A, technology, contract compliance, among other areas, and currently advises corporate clients on financial contracting and technologies. Lee Reiners is Executive Director of Duke Global Financial Markets Center, which is housed at the Duke University School of Law. Lee teaches financial policy and regulatory practice and previously worked on risk and regulation issues for the Federal Reserve Bank of New York. And Russell Wong is an economist at the Federal Reserve Bank of Richmond. Russell conducts policy analysis focused on payments and settlements, including electronic money and central counterparty clearing. So a great group of experts to wade through some of these issues. We're going to touch on three main areas with this panel. The first one is capital raising. We've certainly talked about ICOs, but we're going to dig in a little bit more to some of these issues from a regulatory perspective, payments, and then finally kind of consumer products and finance. So clearly the financial world is changing. It's getting more complicated in increasingly unforeseen ways. So I want to start with some very basic things. So I've taught intro finance here, where I've tried to explain what's a security, what's a stock, what's a bond. I've taught the macroeconomics and kind of international macro thing, where I tried to explain what a currency was. And I thought I knew what those things were until recently. But I think, obviously there is this issue, and it seems to be open for debate, like what is a security, what is a currency, what is the Howey test, right? So that's come up a couple times today, and how is it important for regulatory issues around fintech? So I'm not sure who wants to go first, but Lee, I think in our call you had sort of brought up the Howey test as sort of an important issue. Maybe it makes sense to give a little bit more color around that and your opinions in terms of David's 4 points there and how they apply to fintech.
Sure. Well, Professor Yermak was right on with his 4 points. So the Howey test is came about from a Supreme Court case in 1946, and it had to deal with orange groves, right, and an investment contract on top of orange groves, which is why so many crypto enthusiasts kind of get a little upset that this case from 1946, applicable to orange groves, is determining sort of how ICOs and the broader crypto industry is regulated, and understandably so. So to sort of revisit some of David's points, it's a 4-part test, right? In order to classify as an investment contract and therefore a security subject to SEC registration, you have to meet all 4 prongs of this test. So first, is it an investment of money? Is it in a common enterprise? Is there an expectation of profit? And is that profit derived from the efforts of others? I have perhaps a bit of a different take than David on the applicability of Howey to ICOs. I think, one, it's pretty clearly an investment of money. I mean, the SEC has determined through numerous case law that money does not have to be fiat currency. And in fact, cryptocurrency, Bitcoin, is treated as money by the Financial Crimes Enforcement Network, which is a bureau of the U.S. Treasury Department responsible for enforcing Bank Secrecy Act, anti-terrorism financing, stuff like that. So at one level, cryptocurrency is already treated as money. Is it in a common enterprise? I think it's pretty clear that's a common enterprise. Is there an expectation of profit? And that's sort of the real sort of question mark. And part of the issue is that it's hard to look into the mind of the investor, right? Why is the investor buying this token? I might be buying Filecoin because I actually do have a genuine need for file storage, but I might just be buying it because I think the token's going to go up in value and I'll be able to sell it for a higher price in the future. So that's very challenging. And then to sort of Cam's presentation, that's when you have to look at how this thing is marketed, right? Because if in the marketing materials they're saying things like, well, this is an investment, you'll be able to make a profit, well, then clearly the issuer, all right, or whoever's building this product, typically it's a blockchain type of solution, envisions this as a fundraising mechanism and a security, right? So then the fourth prong is an investment of money in a common enterprise with the expectation of profit. Is that profit derived from the efforts of others? That depends, right? And so, right now, sort of the North Star for a lot of ICO issuers is the DAO, the Decentralized Autonomous Organization case, right? And that's a pretty infamous token. It ended up being hacked, and so it's sort of a moot point now. But because of that hack, we now have Ethereum and Ethereum Classic. So a hard fork was created to recoup the investors' profit. But the SEC sort of went in after the fact, right, and they looked at the DAO white paper, sort of the terms and conditions surrounding that, and they came up sort of with a classification that this thing actually was a investment contract per the terms of the Howey test, and that's not sort of official guidance, right? It's just applying the Howey test to one unique case, but really that's what ICO issuers have been relying on. It's not it's not a lot of clarity. So there's definitely a lot of question marks. And to David's point around what Bill Hinman said, who's the director of Corp Fin at the SEC, over the summer, someone asked him about Ethereum, and he was saying that, in the eyes of the SEC, at least SEC staff, that they do think it's possible for something to start off as centralized and become decentralized at some point during its life, right? And therefore not be a security in that later point. And specifically, he was talking about Ethereum, because Ethereum, has all the hallmarks of an ICO. If you look at the sort of the birth of Ethereum, right? It was issued by the Ethereum Foundation, set up in Switzerland, and they received Bitcoin, right? So you sent in Bitcoin, and then in return you got Ether, and then it was sort of promoted by the Ethereum Foundation, right? They were behind it, they controlled it, they set up the software, the protocol that governs how many Ether tokens are created. But now that it's sort of been out there and used as a currency, it's sort of lost that centralized sort of function. And the SEC said, it is in fact now decentralized enough that it's not a security, it's a currency or a commodity subject to CFTC jurisdiction. So that was specific to Ethereum. They have not yet commented on Ripple's status, right? And that is sort of a big gray cloud hanging over Ripple. And I know they're a sponsor of this event, so I'm not going to exercise my judgment on that case, and I think it's very murky. But nonetheless, you're talking about a billion-dollar company that the SEC could very quickly put out of business if they determine that XRP, which Ripple is sitting on a lot of, is in fact a security. So if you ever go to if you go to enough of these fintech conferences, you'll frequently hear people from Ripple vigorously arguing the case that they are not a security.
Yeah, great. So Anna, what are you hearing from clients that are either interested in buying or selling various types of crypto assets? What are sort of the regulatory concerns that they have? What kind of traps are they worried about falling in? How does this currency versus security issue enter into advice that's being given to companies?
Well, that's always the hard part, right, for the lawyers, because people come in with great ideas and they're very excited, and then you have to explain what the rules are. And that's across the board with all sorts of companies. But I think what, it helps to look at each situation and focus on a dichotomy between investment versus consumption. And so, if you're buying something for consumption, that's not a security. If you're buying it for an investment purpose, that then you're more likely to be in an area of concern. And, I think about the Howey test, and as I've had over the years, entrepreneurs come to me with ideas, you really have to look at, if they are trying to raise money to build something, then typically they really are trying to sell a security, no matter how they've packaged it or what they've called it. But if they're producing something to just be consumed, then they're in a safer area. And so, a few other things to think about in this arena is that really, I heard someone earlier talk about SEC approval. The SEC doesn't approve anything. The SEC is about disclosure for investors, and that goes back to some of the checklists on what do you want to ask about and know about. And so the securities laws are set up to make sure that either people who are coming out of pocket for something, either they're sophisticated enough on their own to have a background where they can be able to evaluate what they're buying, or they're sophisticated enough to know that they don't know, and they're able to hire advisors or take the risk that if they lost it all, it's no big deal. And if you aren't in that category of accredited investor sophistication, then there are rules, even for private placements, about disclosure. And of course, if you do public offerings or public companies, that's all about disclosure too. And you can argue about how helpful is the disclosure, but companies are required to put forward a lot of the information that someone taking their money and using it to buy this item would like to know and should know in advance. And so I think, when you think about is it a security or not, if the person buying it would really like to know information that is more investment oriented, that's kind of a good signal too. If you're buying a bottle of water, you want to know that it's not contaminated or whatever, but there's a different sort of regulation that applies to marketing of products that are going to be consumed versus investments. So, and just one other thing I thought I would mention based on the last speaker is that, the SEC can do a lot. So it's not just the private actions, which can be important, but, they refer to the DOJ, so there are criminal actions, and probably the scariest for any company that has raised money is, private lawsuits where people who have invested can sue. And so if it's, a very contained situation where there aren't many people, that's individual liability. So one thing I always want entrepreneurs to know is that, the reason that you really want to do what you can to follow the securities laws is that you could have personal liability, even if you've set up a corporation and there's limited liability for some things. Individuals can have personal liability for securities laws violations.
Mm-hmm. Very interesting. So Russell, you've done work in payments and settlements, but also electronic money, and is there sort of a research perspective it's important for the capital raising question around this? How are Fed people, especially in the research community, thinking about how the central bank is going to approach some of these issues around capital raising?
Yeah, so I think I have the microphone. Yes.
Okay, good.
Yeah. So I think David raised a really interesting point about, should we classify the ICO in terms of is it really a currency or is it really a security? So even though it is, if it delivers some consumption good, but there's a market value for reselling it, right? So you can make profit for that, although it's directly for consumption, right? So even though if I crowdfunding a pizza place, so then it deliver pizza, then I can resell the pizza and then make some money back. So then in this sense, it looks like security, although it deliver pizza in the ICO thing. So there's one thing. So in the Federal Reserve, I cannot speak for Federal Reserve, but for a central bank point of view, so I think the researcher in central bank are interested in the currency part. So in the old days, so when we start talking about Bitcoin, so we talk about it more like a money. So and now it shifts the discussion to whether it's a security. But the original point is about the central bank are heavily interested in researching about the cryptocurrency, in particular Bitcoin, for several reasons. So my previous job was in the Bank of Canada. So I think at that time it's around 2010, 2011. So we mean the Bank of Canada. So Bank of Canada may be one of the most earliest central banks are interested in researching in cryptocurrency. So we help building up a whole new research team about, okay, how this work, what will be the market impact on this one, what will be the financial stability. So whether the central bank should issue the cryptocurrency rather than on the private market. And then we built a whole team about doing this thing. And in particular, for ICO in terms of a new currency, the impact to the central banking is something like this. So, and then also why we are interested in that is, first of all, this is a direct competitor. So we can issue, Federal Reserve can issue their own money. Now that someone can come in and issue their own money. So it is a competitor to us, so it will steal away our tingery revenue. So we are kind of interested in that one, right? And the second one at that time is around 2010, 2011. A lot of people are talking about zero lower bound. So we are running out of weapons to fight the crisis because the interest rate already hit the zero lower bound. We cannot reduce it anymore. So in this case, we are looking at some electronic asset that can break below the zero lower bound. Something look like the cryptocurrency. If everyone is holding the cryptocurrency, no way you can avoid the negative interest rate. So if the central bank wants to announce a negative interest rate, so what should the usual people do? So let's say the interest rate of the nominal bond. So if I now say, okay, the nominal interest rate is negative 2%, so the natural reaction is that you just dump the bond, right? You sell in the market. Then in this case, this means that we cannot really implement the negative interest rate if we want to have some more tools to fight for the crisis. So then by holding the cryptocurrency, you cannot avoid it. Everyone will go automatically deduct by 2%. We can kind of program it in something like the smart contract. So that's also another reason why at that time the central bank are interested in researching the cryptocurrency. And later on, it maybe not really something the advantage of the central bank. Yeah. So, but maybe we will talk more about that later. Yeah.
Good.
Greg, before we move on, I do want to touch briefly on the regulation of cryptocurrency, because thus far we've talked a lot about ICOs, which I agree is sort of confusing how it's regulated, but it's nowhere near as confusing as the regulatory environment for cryptocurrency. So recognizing that most folks in this room are not lawyers, it might be helpful to just provide a quick overview. So, most importantly, the Commodity Futures Trading Commission has classified Bitcoin and by extension most other cryptocurrencies to be a commodity. And what does that mean? Well, the CFTC does not regulate commodity spot markets, right? So if you have a Coinbase account or a Kraken account, that's not regulated. Those entities are not regulated at the federal level, right? Provided that all they're doing is offering for sale and purchase standard sort of cryptocurrencies and not tokens, right? But then, so, when does it become a security? Well, if you package cryptocurrency into some kind of investment vehicle, and then you sell an ownership interest in that vehicle, then it becomes a security subject to the SEC's jurisdiction, right? Which is why the SEC would have to sign off before there's any kind of Bitcoin exchange-traded fund, right? But the CFTC is the one that has to sign off on Bitcoin futures, right? So any type of commodity derivative, the CFTC will have oversight over. So now we have this sort of weird dynamic due to just the nature of our regulatory system, where we have cash-settled Bitcoin futures, right, which came into existence in December 2017, right when the $20,000 peak was hit. But we still do not have a Bitcoin ETF. Primarily because of the skepticism from Chairman Clayton that David highlighted. But functionally, both products provide essentially the same type of exposure, right? Which is Bitcoin without having to actually own Bitcoin. You can debate the merits of whether or not we need cryptocurrency futures and how far we've strayed from Satoshi's original vision, but that's another conversation. I've highlighted that in some instances, cryptocurrency is treated as money. It's certainly considered money by, as I said, the Financial Crimes Enforcement Network, but most states also consider it money. In the United States, money transmitters are licensed at the state level. So that means, again, firms like Coinbase or Kraken will generally have to get a license in every state that they wish to provide their service to. And then there's one unique sort of exception to all this, which is New York, which went ahead and created the infamous BIT license, which is, if you go to enough crypto conferences again, this will get brought up, and it's reviled, to say the least. And Benjamin Lawsky, who was the head of the New York Department of Financial Services, is public enemy number one within many in crypto. And then he actually, after he left, started his own consulting firm, but he's now a board member on Ripple. So I've heard it characterized that while he was head of New York DFS, he built a moat, and then when he left DFS, he started charging people to cross the moat. So the revolving door is certainly in play on that one. And what the BIT license is, really at a high level, is that it's a sort of standard money transmissions license, but on steroids, right? Far, far more stringent than your typical state money transmission license. And then the last sort of piece, as far as how crypto is regulated, is as a security, or as property by the IRS. All right, so that means you have to pay capital gains, short-term or long-term, depending on how long you hold cryptocurrency. So if I were to pay for a cup of coffee with Bitcoin, I would have to technically pay capital gains taxes on the amount that the Bitcoin went up by from the time I purchased it to the time I spent it to purchase that coffee, on top of the sales taxes that I would obviously have to pay on the coffee as well. So it's clearly a mess, right? It's a function of our convoluted regulatory system, and I think there's obviously a need to simplify that and provide some additional clarity. But at the end of the day, it's going to take an act of Congress to bring that about.
Can I add one thing?
Sure.
So about regulation of securities, so I cannot say much, but about regulation on currency. So actually, there is not much regulation on currency. From the Federal Reserve, I can say every bank can issue their own currency, actually. So after 1994, so the law, which is a prohibited bank from issuing currency, is now removed. So, but having said that, as long as you are not issuing something close to or look like a Federal Reserve bank look, so in this case you are fine. Otherwise, you will say you are counterfeiting. So in this case, everyone can do it. But even that, so we don't see many private banks that are issuing their own cryptocurrency or private credit. So something like Visa, they have tried that before, but it doesn't gain enough market network effect. So then in this case, so maybe there's another way for the ICO to do it, and maybe go through the currency part, which is maybe less regulating pressure on this one.
Very good, thanks. So we've spent a lot of time thinking about crypto and ICOs, but I mean there's a whole other very important side to capital raising that fintech is facilitating or trying to facilitate, sort of non-bank lending, providing more direct access to capital, peer-to-peer markets. So I'm sort of curious, and Anna, maybe you see clients. Curious about what are the pros and cons of non-bank capital raising separate from the kind of crypto space.
Sure, not to kind of be a broken record, so I won't spend much time, but of course, loans can be securities too. And so peer-to-peer networks or lending networks like Kiva, where there's no expectation of a return on the interest, that's kind of been cleared. But other platforms where you would have an expectation of the return of interest, that can get in the danger zone of being securities as well. But I think, what's kind of interesting to me on the advances or the pushing forward in the lending area is, the great possibility of opening lending to markets that are underserved now, but at the same time, the danger, because of course you have lots of regulations around fair lending, so there's no discrimination, and so you want to be careful, particularly when you have algorithms and all sorts of inputs that, again, could have great potential. You want to make sure that those don't unintentionally lead to problems that, that banks have been grappling with all along.
Yeah, absolutely.
To follow up on that, just to put the sort of peer-to-peer lending industry in a bit of context, and a lot of people refer to it as sort of marketplace lending or online lending as well, generally referring to the same thing. But this was really born in response to the financial crisis, and we've heard from other panelists the loss of trust in traditional financial institutions that arose, and more people were willing to engage with technology firms that were providing financial services. But then also big banks pulled back significantly from certain lending segments, in particular small business lending. So if you look at the data, big bank lending to small businesses is still below what it was immediately preceding the financial crisis. So this would provide an opportunity for new fintech firms, non-bank lenders, to step in and fill that void and expand access to credit. So there is great sort of potential, and a lot of policymakers are excited around the ability for peer-to-peer lending to expand access to credit. So the one sort of caveat or to sort of dampen that enthusiasm somewhat is we have to keep in mind that this industry has only existed, as I said, post-financial crisis. And as the gentleman pointed out earlier, this has been the longest bull market in U.S. history, right? So these models really haven't been thoroughly tested during a market downturn. And the algorithm, right, the credit scoring algorithm, I mean, this is their secret sauce, right? That's what differentiates them. We don't, the public does not have a lot of visibility. Regulators do not have a lot of visibility into that. So time will tell, and I think you're already starting to see some of these firms suffer. And the other thing I'll add, the final thing is that, most of these firms are partnering with traditional financial institutions, banks, in some way in order to get around the state-by-state regulatory system that applies to non-bank lenders. So lending is regulated, non-bank lending is regulated by the states. So again, you have to get licensed in every state. Obviously, if you're a fintech firm that doesn't have any physical branches, your goal is to operate nationwide day one, right? You just exist as a website somewhere. So that's a big hurdle. And so what many of these non-bank lenders have started to do is partner, and have been doing, is partnering with banks, right? So where the bank is the one that actually originates the loan. Then after a day or two, the fintech firm will then buy that loan and then sell it on to an investor, or package it and perhaps securitize it as well. And that allows the fintech firm, again, to get around the state-by-state licensing regime, but also get around state-by-state interest rate restrictions, right? So they'll generally partner with banks that are in Utah. Utah is very popular because there's very high, actually there's no usury cap in Utah. There's a few other states that are very popular for fintechs partnering with banks. So by no means is this sort of done away with banks, and this is sort of called the rent-a-charter model, and it's controversial. And actually, there was a Second Circuit decision called Madden versus Midland, in which the sort of valid when made principle was considered void by the Second Circuit, meaning that a loan that upon being made, as long as it's valid, it will remain valid for the life of that loan. So if a bank makes a loan and then sells it on, it will remain legally valid. This sort of notion has underpinned a lot of our financial system for a long time. So right now, you're actually seeing less fintech lending in Second Circuit states of New York and parts of Connecticut. So we have a split circuit right now. Eventually, it'll make its way to the Supreme Court. But a lot of eyes are on that case for sure.
Yeah, so Russell, thoughts about kind of non-bank lending and how the Fed's viewing this, or research that you've been doing?
Yeah, so they're actually quite interesting research questions, at least to myself. So the P2P is actually a very different type of the business model, right? So usually we talk about the banking. So what bank does is what we call the maturity transformation. So I was teaching monetary economics in Kingston, Canada before. So what bank does is to take the deposit, and the deposit will promise you can withdraw anytime, right? So and at the same time, the bank will take the money to make the bank loan. So then for the borrower, you can take your time. Maybe usually the credit line is requiring 3 years. So Within the 3 years, you can pay back your loan. But at the same time, the bank is sitting something in middle, doing this kind of the maturity transformation. So the bank, they will borrow short and then lend long. So at the same time, he earned the interest margin, right? So when I promise the deposit, which is maybe 0 or 1%, and now I lend long will become, I can earn maybe 8%. So I earn the margin between 6% in this case. But the downside of doing this maturity transformation is that now I pay a loss of risk right here, right? So what happens if a loss of a depositor come to run my bank? And my borrower haven't paid back my money, then my bank will be in trouble. So, but the good thing about this maturity transformation is that not everyone can afford something that borrowing short. For example, if I want to buy a house, so I run into a mortgage contract. So I need a huge amount of money. So, and then I need that. I need to take maybe more than 10 years to pay back my mortgage. So I cannot pay back in next year because the money is so many. Then in this case, I need a bank to do something like this maturity transformation. And I don't see the P2P can add something like this, right? So whether the P2P lending can do this kind of maturity transformation. Maybe for some small amount of project like 1,000, 2,000, it can do it. But for some very big amounts of money, maybe we still need banking to do that. Mm-hmm. So then in this case, I still see there's a need for banking in general, in a traditional sense. Mm-hmm. But for P2P, maybe it may be another business model to take account into that. Mm-hmm. Especially after the financial crisis, we have the Dodd-Frank, and now the interest rate is super low, and then they have a lot of people complaining a lot of burden in opening a new bank. So United States have a lot of banks, amazingly a lot. So in my previous job, I work in Canada. So there is essentially 16 big banks in the whole Canada. But in United States, there are more than 10,000. So a very, very different kind of the market. But after the crisis, because a lot of things changing, so we don't see a lot of bank entry anymore. So it creates a new market like Lee say, now where the money comes from. If someone needs the money, then maybe now the P2P can come in and then make this some small loan to these people. That I think maybe something promising can be going on compared to the traditional banking.
Mm-hmm. Great. So we have about 15 minutes left, and we've only gotten through our first topic yet, so we're gonna move on. But I want to talk about payments. We've touched on payments some, but I think there are these bigger issues about especially in the interbank market globally, and certainly Ripple is in this market. But just thinking about where are we seeing the most activity in new payment systems? Why is that? How does this relate to things like legacy systems in developed versus developing economies? So I'm not sure we want to start here. I mean, I think Russell is probably closest to the work that you've done. What do you see as the driving forces there on the payment side?
So I think most of the developed countries running the payment system in two levels. So what we call the two-tier system. So on the retail side, we have banks. So people have bank accounts. So how they send money to other people is go through the bank network, right? I send my money, maybe now they have Zelle, right? So, but in the old day, maybe I send you a check and then you cash in the check, go from one bank to another bank. But this is on the retail level. But banks also have to settle among themselves, right? So they aggregate all the transfer among each bank. And then we have the wholesale level, which is the FedWire is doing. So, and then it's provided by the central bank. So central bank now provide an infrastructure for the bank to settle among themselves. And then the way we run is called the real-time gross settlement. So it is a nice thing to do it. So what is real-time mean? Okay, when you send something, I mean on the bank level, not on the retail level. When the bank sends some money means in terms of the Federal Reserve. So every bank open an account in Federal Reserve, then everything will be measured in terms of the reserve. So reserve now is not only a reserve requirement to satisfy, but also as a payment. When the bank owns some bank other money, I can send you some reserve, look like to settle the money I owe you. So then in this case, it is real-time means that when I send you some reserve, I mean bank, so it is real-time settled. As long as I have some balance in my reserve account. So in this case, it is a gross settlement. So you cannot go zero, which is nice because now you don't need to worry about liquidity Or what happens if you can go below zero, then the bank suddenly bankruptcy or run away, then the guy have no money to pay me back. So it is super secure and super liquid. But the downside of having the real-time gross settlement system is, first of all, okay, some people, maybe I don't have money to send it to you right now, but I'm expecting the next minute some people will send me the money. Then in this case, I cannot go below zero. Then I have to wait a little bit before I get the money from other bank. Then I can make the payment to you. So in this case, the real-time gross settlement system is much lower than the net settlement system, which is operating in Canada and most of the European countries. So then here in this case, actually maybe the cryptocurrency can help, right? Because the nice thing about the cryptocurrency is the real-time, and it's much faster, and then we don't need to worry about the security issue. As long as everything is open to public, we have the distributed ledger. That's also the reason why a lot of central banks are considering building their own blockchain. Then in this case, we can fasten the payment structure in this case. But it's still a lot of ongoing issue about that. Yeah.
Yeah. And Lee, from your perspective, what do you see as the big issues in payments and where adoption is going to happen most rapidly and be most valued?
Well, in the U.S., I think the biggest issue is that we don't have one regulatory agency that has a mandate to bring about faster real-time retail payments. The Federal Reserve has tried through moral suasion. So a few years ago, they established a faster payments task force where they gather together all the financial institutions and big payments firms, and they basically said, "Okay, guys, how do we fix this?" And they produced a really good report with some great recommendations. But at the end of the day, the Federal Reserve does not have the power to make that a reality. Now, one option is to just give everyone, all retail customers, access to the Federal Reserve's balance sheet. Because right now, payments, obviously interbank payments, flow through the Federal Reserve, right through FedWire and other systems. And that could be done through a Fed coin, right? They could roll out their own distributed ledger, or they could just give us electronic access, similar to how banks have electronic access. But clearly the U.S. is behind, specifically in Asia. When you have Alipay or Ant Financial and WeChat Pay, who are just dominating the market. It's all QR code-based system. There was a great 60 Minutes story the other week on this. Alipay started a Yuibao, which is in 3 years' time became the world's largest money market fund by a factor of 2. So they grew to $200+ billion assets under management in just 2 years, and it translates to hidden treasure. So these are customers that had an Alipay wallet. The excess cash in there was being swept to Yuibao, and the Chinese government was not too happy about this quick growth. But clearly we're lagging, and I think one of the fundamental issues is that for most of us, the U.S. payment system works generally well, right? There's not this overarching sort of a need that's being driven from consumers. Now, if you're a lower income person, that's clearly a different story, right? I mean, I have Chase Sapphire as well. The points are awesome, but because of that, and because of those points, prices for most goods are higher. And by law, retailers have to sell to everyone for the same price regardless of payment method. So actually, lower income people are getting screwed over the most with our U.S. Payment system. And I think, again, it's a policy objective and promise for a lot of these cryptocurrency technologies is to lower those transactions costs. But unless the Federal Reserve or Congress gives the Federal Reserve power to implement faster real-time payments, we're just going to be a laggard for the foreseeable future.
Mm-hmm. Very interesting.
Can I one thing? So far there is a group of big banks. So they what we call the chip system. So chip is a collision of a big bank. So they can send payment among themselves, so which is super quick because you don't need to go through the FedWire system. They can totally do it. So but a lot of people complain about it is a big boy league. So other small local bank can enjoy the chip system, and then they have to rely on the member of the chips to send through the system like this. But so that's why the fast payment system, so we call it market-based. So let's see what the market participant want to do something like that, because they already do something like that, like the chip system. And within, Lee mentioned about the Fed coin. So the economists within the system had discussed about something like that. So my personal take is, okay, maybe we don't have the enough competitive advantage to do something like that. First of all, the whole idea is blockchain is anti-central bank, right? So they don't like central bank, that's why they want to start their own payment settlement system. And the second thing is about the scalability. So United States is a 20 trillion economy. So now so far there's some transaction on day-to-day, minute-to-minute basis for Bitcoin. But when we talk about a 20 trillion economy, everyone can send money every time to everyone, anywhere. So then in this case, maybe the Federal Reserve doesn't have enough capacity to do something like that big. And some people may counter-argue, okay, this is not really the case because everyone, for example, passport, everyone have an account to the government, right? So in this case, we can handle everyone have one account. But the downside is, okay, we cannot handle everyone can do business at every minute. For the high frequency one, maybe we cannot do it at the retail level. But on the account basis, maybe we can do that. And other thing is about the, as I said before, about the maturity transformation. So what happens if we do the Fed coin, we take some people money, so then what should we do about that money? So for the bank, it do something good, right? Because when I take the deposit, it will lend out to the business owner. So it can create more investment, more employment. But for Fed, there's nothing we can do. We cannot lend out the money to firm, to other people to do investment. So bank is filling out this role. So then maybe this is not a good reason to kill that by doing the Fed coin. So,
Very interesting. All right, so I'm going to move on quickly because I've got another fundamental question. I used to think I knew what a financial advisor was, but I guess that is a bit in question now. And I guess, for me, one of the fundamental issues is like how do we know, especially as we move into technologies where the problems are not being solved through well-known algorithms, we're moving into machine learning, alternative intelligence, artificial intelligence schemes where the model is not something that can be well regulated, well specified. What kind of risk does this pose for financial institutions? What kind of risk does it pose for consumers? It just feels to me like there's if this is going to go to the next level, there's a whole bunch of issues that need to be resolved. And I don't know what to say. I mean, Anna, how are companies thinking about this?
So, I guess thinking about it from a consumer side, for things like financial advisors, or really you could take it into any sort of category. But if you think about financial advisors, depending on how an advisor, a human advisor, is registered and what they're doing, they may have fiduciary duties to you as a client. They have to think about, are the investments appropriate for you? And so, you can argue about, do people really do that? Is that the true state of the market anyway? But those laws are there to protect people, if someone really falls down on the job and there's a loss. And so, when you get into machine learning, AI, and thinking about that, it will be interesting to see how that is accomplished. So that's not to say that you couldn't have appropriate investments or a sort of fiduciary duty, but it's certainly very different than the way that we've thought about it when it's people giving the advice.
Yeah, I'm a big fan of robo-advisors because I think it gives more people the ability and access to save for retirement. So, really, robo-advisors are just capitalizing on modern portfolio theory, behavioral economics, and new technology, right? So, by now, hopefully you all know that most of us are just better off indexing, right? So buying the S&P 500 index and setting and forgetting it and coming back when we retire, because humans are really bad generally at picking stocks, right? So why do I need a human advisor when there's an algorithm that can just do that for me, right? So it lowers fees. Most robo-advisors have no or very low minimum investment amounts, so again, expands access. And at the end of the day, and I think time will show this, you'll have better investment results. So for that, I think robo-advisors are clearly here to stay. I think the question is sort of what does the industry look like? Because in relatively short order, you've had sort of standalone robo-advisors, the most prominent being sort of Betterment and Wealthfront, quickly surpassed by traditional investment advisors or other money management firms who have rolled out their own robo-advisor solution, right? So Vanguard, for instance, is by far the largest robo-advisor. They have over 100 billion assets under management under their robo-advisor platform. Schwab is another very prominent robo-advisor platform as well. And, it's not hard to see why these firms have an advantage over the standalone robo-advisors. One, they have name recognition and trust, right? So consumers are more willing to invest their savings with these firms. And they also have cross-selling opportunities, right? So they can provide their robo-advisors with cash management products or other type of products. And they have their own ETFs, right? So Schwab has ETFs. And if you're a Schwab customer, it's zero fees on those ETFs. So if you're a Schwab robo customer, you get put into the Schwab ETF. Now, it does raise some interesting sort of fiduciary questions. One specifically is most robo-advisors have an affiliate broker-dealer, right? And that affiliate broker-dealer is executing the transactions, right, from the robo-advisor. Is the client sort of getting the best price, right? What's the bid-ask spread? It's not illegal if they're not getting the best price, but it needs to be disclosed, right, to the customer. And then the point about the ETFs, right? Obviously, Schwab has an incentive to put their Schwab robo clients into Schwab ETFs. Is that the best product for Schwab customers? Maybe, maybe not. So that is a conflict of interest. But as long as it's disclosed, the SEC has determined that you can meet your fiduciary duty. Now, there are some public policy risk around robo-advisors, but it's not unique to robo-advisors because it applies to just passive investing in general. One is which is sort of client herding. There's this great analogy. I wish I knew the professors who said it, but if you think of sort of a restaurant recommendation, right? So previously, if you were traveling somewhere, you would go to the hotel concierge and ask, what's a great restaurant nearby? Now we probably just take out our phone and Google it, right? So if Google is sort of giving us the top of the search, a restaurant that's not very good, and we're all going to bad restaurants when we're in a certain city, that's very different than if just one concierge tells Lee to go to one bad restaurant, right? Now, obviously, the consequences of going to a bad restaurant aren't as dire as if there's one, if robo-advisors are telling all of us to get into certain products, right? That then there turns out to be a problem. Right, so you have this herding behavior going on, and there's also some concerns around corporate governance, right? And this has been brought up in other contexts as well. The recently departed Jack Bogle brought this up as well because ETFs, the voting rights are owned or controlled by the ETF sponsor, right? Not by the investor in the ETF, right? Most ETF sponsors generally are not exercising or care all that much about those voting rights. And so what does that do for accountability and corporate governance? And the final piece that Anna touched on is what happens when machine learning, artificial neural networks get incorporated into these algorithms and the investment decisions being made are no longer understandable by the programmers or the robo-advisor firm, right? Can we still think that there's a fiduciary duty, right, that's applicable to the firm? In that case, we're not there yet, but I think we'll be there fairly close. And again, this is sort of a broader question around, what type of liability regime should we apply to artificial intelligence and robots that some jurisdictions, particularly in Europe, are starting to think of. In the U.S., there's not nearly enough attention that's being put on this this issue in Congress.
All right, so got just a couple minutes. Entertain a question or two if anyone has a question for the panel. Yeah.
Well, Farah, thank you for your time, and now I understand why legal advice in US is so expensive. It's obviously you have so many bodies, and the question is, so you have like IRS, Securities Exchange Commission, and several other bodies that have their own interpretation. Now you have courts who interpret the law, and in some law taking because that you have a common law system, it kind of creates new rules that you have to follow, and everyone goes back to those precedents. And also you have federal regulation and you have general for the whole country regulation. Now, the question is, isn't it easier for companies to combine and lobby a clear law that would go for everyone and like a clear definition, whether it is a security, whether it is a currency, in what cases? Isn't it easier to solve like this, or it's not possible?
So it would certainly be easier to have, to have a federal solution. And there have been instances where that has happened. So, outside of fintech and just the securities laws in general, we did have legislation, I guess in the 90s or early 2000s, that gave federal preemption for Reg D offerings. So that you didn't have to meet the federal exemptions in a private placement under Reg D in certain circumstances, and then meet all the state regulations as well. So it can happen. In that instance, it came about because on the state level, the securities administrators were able to get comfortable that that particular exemption had enough consumer protection, and it was only for accredited investors, and so there was enough, pressure on one side and assurance that all the regulators kind of let it go. But in other ways, that has not worked. So, for instance, with crowdfunding, the original ideas that were put forward, in some cases from some of our representatives in North Carolina, they got peeled back quite a bit before they were actually enacted. And that's really state securities administrators, not being comfortable with it. And one thing that I had thought about talking about with payments, but won't go into much, but another layer that is complicated in the U.S. is what law even applies. So you have local, state, federal, but then you have a particular issue and you say, how is this even going to be interpreted? So in some instances for fintech or other lending platforms, companies have attempted to take advantage of states with good lender-friendly laws. And so they will put in their contracts, I choose the law of whatever. There's even some interesting cases where companies have chosen tribal law because it is very friendly in terms of lending. And so, if those are respected, you can kind of, coordinate and have your contracts so that that's helpful, but sometimes those aren't respected. And with the tribal law, the CFPB brought actions to say, that shouldn't be respected. So it's even murkier than having all the levels because there's not clarity all the time on what law will actually even apply.
Well, I think on that note, we'll wrap things up for the panel for the day. So first of all, thank you very much to the panelists. Appreciate you being here. I think it's been a really enlightening afternoon. I think we've got a lot that we need to learn and think about going forward. I think feels like it's really still the first inning in terms of a lot of these technologies. Definitely want to thank our sponsor, Ripple, for the work that they've been doing. Thank all of the participants that were here and those that we hopefully engaged through the live stream as well. And now it's time to kick back a little bit. I hope you'll all join us for a reception downstairs in the lounge. It's when you first came in, the lounge was on your